Hey folks, so welcome you all to a new session. This is CA Ganesh Bharadwaj. So now let's get started with a brand new chapter, officially the first chapter of the syllabus as per our order, which is portfolio management. Right now, guys, as I mentioned in the introductory session, this is a big chapter, and of course this is a very important chapter from an examination perspective. In our AFM syllabus we have four big chapters, you can say big four, right? So one is portfolio management, then you have a chapter called securities valuation, that is also big. Then you have a chapter called forex, that is the biggest of all. And then you have derivatives. These are the four big chapters, and this is one of the four big chapters in our syllabus, a beautiful chapter and a perfect way to get started into our financial management journey. Yes, of course, in the previous session we also saw the basics of stock market, and trust me guys, whatever we've seen in the previous session, that is the basics of stock market, we will be actually using all those learnings in this particular chapter. Throughout this chapter we will be using, and of course this chapter also has some dose of statistics in it. Right now in this chapter we will be using some statistical tools like arithmetic mean, your standard deviation, variance and all. Now just because we are seeing statistics in this chapter, don't think the entire subject is going to be statistics driven. Absolutely not. So I told you in the introductory session itself that I have bifurcated this entire syllabus into multiple parts. This first part, in that especially this particular chapter, has a great deal of statistics in it, right? So this is confined predominantly to this chapter, and a few other areas will be seeing statistics, but beyond that don't think entire financial management is relating to statistics. Is that clear, guys? Right, this is one brief background I wanted to give you before we enter into this chapter. On that note, shall we get started? Yes, let's get started. Now guys, the name of this chapter is portfolio management, right? Now the first question here is, what do you mean by a portfolio? Please catch up running notes. So certain things are there, predominantly everything is there in our concept book. I've told you many times, the actual learning comes only in our classroom discussion, right? The book is there, but the background logics, right, the interlinking of multiple areas happen only through the classroom discussion. So please catch up running notes wherever possible. Blue ink, right? Fine guys, let's get started. Now what do you mean by a portfolio? Now before that, as usual in our signature style, I'll give you guys an example. Let us say you have 10 lakh rupees with you, right? You have 10 lakh rupees with you. Now you want to invest this 10 lakh rupees in the stock markets, right? Now I'm giving you two options. Option number one, will you invest this entire 10 lakh in one share, let us say ITC, right? Yesterday in the practical session I showed you the demo of in my Zerodha account I opened and we placed orders and all. We saw the practical of that, right? Now entire 10 lakh rupees worth of 10 lakh rupees I buy ITC share. This is option number one. Or option number two, no, with this 10 lakh rupees what I do, I invest in 10 different shares for 1 lakh rupee each. In this case overall I've invested only 10 lakhs, but I didn't invest the entire 10 lakh in a single stock, right? I have invested 1 lakh each across 10 different stocks. Now you tell me guys, which one would you prefer? Would you prefer option A or would you prefer option B? Come on, quick. Would you prefer option A or B? Okay, most of you are saying B. Now the main question is, why do you prefer option B? Now significantly, because many of you might already know the answer to this. Sir, if I actually invest everything in a single stock, right, if it goes up, well and good, my entire 10 lakh will go up. If it goes down, my entire 10 lakh will go down, right? There will be a capital erosion for me, guys, correct? Whereas in option 2 I am investing in 10 different stocks, right? Now one stock might go up, one stock may go down. But on an average, generally, at least the risk here refers to maybe that uncertainty of my expectation not getting fulfilled, right? Maybe at least the risk here is slightly less, guys. Correct or not? Am I right? Guys, this is the thought process behind you people telling me we prefer investing in 10 different stocks instead of putting my entire money in a single stock, right? Now, here we invested in 10 different stocks. We call this as a portfolio of stocks. What do you mean by a portfolio? Portfolio is an English terminology. It's not just confined to your finance. Portfolio means a collection of something. Is that clear? So let's say in my practice, I'm providing tax services, I'm providing advisory services, audit services, and wealth management services. Example, I'm providing a portfolio of services. So portfolio is a normal English term. Is that clear? In the context of finance, it refers to a collection of securities. In this case, I just mentioned shares. It can also be securities. Why? In this 10 lakh, right? So I purchased 8 different stocks for 1 lakh each. How much have I invested? 8 lakhs. The balance 2 lakhs, I purchased one bond. That is also possible. Or I can invest in debenture. That is also possible. Is this clear? So in the context of finance, portfolio refers to what? A collection or a portfolio of securities. Is this clear, guys? This is the basic thing that you need to understand. Please reciprocate. Are you guys able to understand? Perfect. Right? Now you guys understood the meaning of portfolio, right? Now recall the first introductory lecture where I told you at your intermediate level you would have seen finance only from the perspective of company. That's called as corporate finance. Excellent. Whereas at the final level, finance needs to be looked at from 3 different perspectives. One is, of course, the company's perspective, corporate finance. Then the second is investor's perspective. It is called as, I gave you one jargon. Excellent. IAPM. What do you mean by IAPM? Investment analysis and portfolio management. And the third one is from the perspective of risk management. Yes. And this particular chapter fits into the second category, which means it is from the perspective of whom? From the perspective of the person putting his money and investing. Investor's perspective. Are you all able to understand? Is this clear? This is how you need to place yourself. So you need to look at the subject from the lens of the person who is actually investing his money. Are you all able to understand this? Is there any issue till now? Great. Now, portfolio management, right? A person who manages a portfolio of securities is called as a portfolio manager. Now, if you are managing your own money, in this case, we are talking about an individual investor. But recall, I've told you, suppose I gave you that example of driving your car versus renting a car. In which context I gave that example? Mutual funds. Now, if you do not know to invest in shares by yourself, you hand your money to a fund manager who will invest in the markets on your behalf and generate the returns. He will take a fee and give it to you. Guys, I also told you there are different types of products like portfolio management services, PMS, right? AIF. I told you, you guys remember? Now, in this example, this mutual fund manager is a portfolio manager. Why? He manages a portfolio of securities. Is that clear? Right? A person who runs a PMS company, they are also portfolio managers. Are you all able to understand? Now, obviously, this is also indirectly from an investor's perspective only, right? Because they are actually handling only investors' money. Are you all able to understand? Hence the word portfolio management, and predominantly, we are more focused about these people who manage actually loads and loads of money. Are you all able to understand? If you and I invest in the markets, we are called as retail investors. We don't have that much volume. We don't have that much amount of money compared to a corporate. These are institutions. They manage money like anything. So a person who manages money to a large extent, these guys are called as portfolio managers. Are you all able to understand? Some examples of portfolio managers are, I told you right now, mutual fund houses, right? That is one example. Have you guys heard of this venture capital fund. You guys have heard this venture capital fund? Now, you guys have seen this Shark Tank and all. Shark Tank, where some people, they pitch their ideas, and some investors, rich investors, will be investing. There's also something called as private equity. Now, the main difference between a mutual fund and these guys are, mutual funds generally they invest in listed securities, whereas venture capital funds, your private equity funds, these guys actually invest in unlisted companies. Predominantly it could be a private limited companies or even unlisted public companies, right? So a startup has actually come, now these guys invest there. So now in this area, in this segment, actually this is the cream of finance career. Big money involved here. So this is a very good career options even for you guys, right? So once you guys actually, if you are really interested in this particular field, sky is the limit. And this is where actually the core of valuation gets tested, right? So we will see more about this in valuation of security chapter, but here I'm giving you an example of what portfolio managers. Are you all able to understand? Is there any issues till now? Great, guys, clear with this? Perfect. Now sir, this chapter, portfolio management, is clearly from the perspective of an investor or a portfolio manager. From now on, I will use the word portfolio manager, right? Now, when I am investing my money, there are two major things that I am really bothered about. What are they? Number one, when I invest money, right, the first thing that I look at is what? How much will I get out of it? Am I right, guys? How much will I get out of it, right? Now, that is called as return. You guys know that? Return on investment. Return, basically. So how much will you get out of whatever investment that you have made? That is called as return. Now, the most important thing here is not just return. The other one is called as risk. What do you mean by a risk? In simple terms, the expectation of whatever return that you expected, let us say I expected a return of 15%. Now, my actual return may not be 15%. 15% is just an expectation. How will I be able to exactly generate a return of 15%? Guys, correct? So here risk refers to the chance of your expectation not getting fulfilled. That is called as risk. Are you all able to understand? Right? Hence, from an investor's perspective, we are bothered about two things: risk, that is how much return I am going to expect, and return, the return, which is how much amount that I'm expecting out of the investment, and risk, what is this? The chance of my expectation not getting fulfilled. Is everybody able to understand till now? Right? And this entire chapter predominantly revolves around risk and return only. Are you all able to understand this, guys? Fine. Now, with this backdrop, let's go to our concept decoder book. Please take your concept decoder book, right? So for the online folks, yes, you can download this free of cost from our website, costwin.in. So you can download it from there. So we have uploaded it. Now, guys, in this particular chapter, portfolio management, so I have bifurcated this entire chapter into 8 parts. Risk and return, that is the first part we'll be seeing. Then there's something called as CAPM, Sharp Index Model, Arbitrage Pricing Model, Sharp's Optimal Portfolio. There's something called as lines, performance evaluation, portfolio rebalancing. Now, do not worry. Now, don't try to understand everything right now. We will build the subject brick by brick, concept by concept, and we will make it into a beautiful palace. Don't worry about it, right? So one by one we will understand, but for that, the foundational part is what? The concept of risk and return. Slowly from here we will be going. Is that clear, guys? Is that clear? Shall we get started? Perfect. Now, let's get started with the first one. What is the first one? We'll start with return. Don't worry, I will walk you through. I will also read out what is there in our concept book. But for me to do that, first, there are a lot of background explanations required, right? Practical explanations we will be doing. Real life, whatever is happening, we'll be seeing. That is very much required for your examination purposes. Here with this, guys, shall we get started? Great. How do you compute return? Now, first, let us say, let us say, I invested, I invested, in a particular share. Let's take the same example, ITC. I purchased ITC share, right, at rupees 100. At rupees 100. I hold it for 1 year, right? Now, at the end of 1 year, so this I call it as P0. What is P0? The price on today. That is called as P0. Now, 1 year after I invested, the price became how much? 110 rupees. The price became how much? 110 rupees. And during this 1 year, I earned a dividend of how much? Let us say 5 rupees. This is the scenario. Is this clear, guys? Now, you tell me, you invested how much? 100, correct? Now, after 1 year, this 100 became how much? 110. How much have you earned extra? 10 rupees. Now, is that the only earning for you? No. Over and above this, during this 1 year, you earned what? This 5 rupees of dividend as well. That also is a part of your return. Getting it? Right? So, can I say the return that I earned out of this investment is 110 minus 100. This is what? The capital appreciation. Am I right? My capital as appreciated by this 10 rupees. On top of it, I also received this 5 rupees of dividend, which is nothing but a cash flow that I get out of this particular investment. Am I right, guys? Am I right, guys? So how much is this amount coming to? So it's going to be rupees 10 plus rupees 5 is going to be rupees 15. Am I right, guys? Guys, correct? Now, let us say I invested in another share. Let us say HUL, Hindustan Unilever Limited, right? Now, from this particular share, overall, the return that we computed here, 15 rupees. Instead, from this particular share of HUL, let us say I earned a total of 20 rupees. What is this 20 rupees? Capital appreciation plus dividend. Now, you guys tell me, investment in ITC is better or investment in HUL is better? Which is better? Come on, guys, come on, tell me. HUL is better? You cannot say. Why? Now, guys, here I earned 15 rupees by investing how much? By investing how much? 100. Now in HUL I earned 20 rupees. Let us say I invested 200 rupees. Now you tell me, is this amount in absolute sense comparable with each other? No. Can I compare a monkey with a donkey? Compare two monkeys or compare two donkeys? Am I right, guys? So in this case, that is the reason why return is never expressed in rupees. It is always expressed as a percentage. Are you all able to understand? Hence here, the formula for return will be, so 110 minus 100 plus 5, whatever is the absolute return, divided by what? The amount that you invested initially. Is this clear, guys? So here I will say it's going to be 15 rupees upon 100. So it's going to be how much? 15 percentage. Here I will say it's 20 divided upon 200. I will say 10 percentage. Now you tell me ITC is better or HUL is better? Now your entire answer changes. Are you all able to understand this, guys? Hence, now you guys tell me what is the formula for return? If you have to put it in this language of P0, P1, D1, you guys tell me what is the formula? P1 minus P0 plus D1, the whole divided by P0, and this is formula for return. Guys, that's exactly what is mentioned in our concept book also, right? If you look at it here, that's about it. Return is equal to P1 minus P0 plus D or D1, whatever it is, divided by P0 into 100. Always remember, return is expressed as a percentage. Why? If you take it as an absolute sense, it is not comparable. Are you all able to understand? Because the investment base could be different for different securities. Are you all able to understand, guys? Or in other words, can I say, guys, my return is made up of two components. One is my capital appreciation and the other one is, now instead of dividend, I will use a better word. I will call it as cash flow. Why, sir, cash flow? You tell me, is the only security available on the planet your equity shares? No. I just told you, portfolio represents collection of securities. Now, when I say securities, I can invest in shares, I can invest in bonds, right? Here it could be equity shares, I can invest even in preference shares, guys, correct? I can invest in different avenues of investment. So hence we will be using a common terminology called as what? Cash flow. Why? Because in case of a bond, what is the cash flow that you will be getting? Then interest payout. Instead of dividend, you get interest here. Are you all able to understand? But of course, the capital appreciation will not be much. Is this clear, guys? Right? More about bonds we'll be seeing in a separate chapter called securities valuation. We'll be doing it later. As of now, are you guys clear with whatever we have seen till now? Guys, are we clear here? Great. So now what happened here? What happened here? Guys, in the first example that I gave you, we invested how much? Guys, come on, tell me. 100 rupees, right? It became how much? 110, right? And the dividend you received in the first year was how much? 5 rupees. Is this clear, guys? So we saw that the return was how much? 15%. Any problem, any issues here? No. Now I will ask you a question. Can this return be negative? Can this return be negative? Absolutely yes. Why not? Why not? Now let's take an example here. Let's take an example. Another example, example number 2. Please, I hope you guys are catching up running notes. Great. Now let's say I invested 100 rupees, right? Now what happened? At the end of year 1, it became how much? Rupees 80, right? And during this year, I received a dividend of, let us say, 5 rupees, right, guys? So now you tell me, what is going to be my total return? Remember, return should be expressed as a percentage. Come on, guys, tell me. I told you, learn like a child, behave like a professional. So come on, answer back. So tell me, it's going to be 80 minus 100 plus 5 divided by 100. Now, I invested, I entered the market, or when I purchased the share, it was 100 rupees. I paid 100. But after 1 year, it reduced to how much? 80 rupees, which means my capital has eroded, or in other words, I've got a negative capital appreciation. We call it as a capital depreciation. That's about it, right? To the extent of how much? 20 rupees. However, I earned how much? 5 rupees by way of dividend. Hence, the net of you have what? Minus 15 upon 100. It's going to be a negative 15%. Is everyone able to understand? Is there any issue here? Yes, your returns can be in negative. Clear? Clear? That is another concept in this particular thing. Now, example number 3. Let us say P0 is equal to 100, P1 is equal to 110, and P2 is equal to 125. Now, assume there is no dividend. Assume no dividend. Now, is it mandatory for the company to pay dividend every year? No. In this case, there is no dividend, which means the entire return comes out of what? The capital appreciation. Is that clear, guys? Now, my question to you is, now here, how will you compute return? Now, I will say return for year 1 will be how much? P1 minus P0 divided by P0 plus D, which is 0 in this case. Is that clear? So the first year's return will be how much? 110 minus 100 plus 0 divided by 100. How much is it, guys? How much is it? 10%, right? Now, what is the return you earned in year 2? Now, when you are calculating return, always remember, when you are doing it year on year, in this case for year 2, how will you do it? I will say, now, the second year, what was the starting price? 110. And at the end of second year, it became how much? 125, which means this, what was the capital appreciation that happened during the second year? Only this difference, not from base 100. Guys, are you able to understand? Which means here, what should be the formula? You guys tell me. It should be P2 minus P1 divided by P1. Yes, of course, here plus D will always come. It's the second year's dividend, right? Are you all able to understand? That's about it. Which means don't think P0 is always the base, right? Simple, guys. the value at the end of the year minus the value at the beginning of the year divided by the value of the beginning of the year into 100. Is this clear for everyone? Is this clear for everyone? This is how you compute return year on year. Are you all able to understand? Are you all able to understand? So in this case, whatever it is, it's going to be 125 minus 110 upon 110, yes, into 100. So whatever is it, come on, quickly tell me the calculation. So it's coming out to 13.64 percentage. Right? Are you all able to understand this? Any issues, guys? Any issues? Great. Now we saw this concept of return year on year. So per annum. So whatever I say here, it is per annum, no? Guys, correct? This is per annum, an annualized figure, correct? Only then it is comparable between multiple securities. Are you all able to understand? Is there any issue till now? Is there any issue till now? No. Now, let us say, example number 4. Now, let us say I invested today by paying how much? 100 rupees for this particular share, right? Now, I was holding it for 2 years, right? Now, at the end of the second year, the price of the share is how much? 125. Now, guys, remember, in this case, they might ask you in exam to calculate something called as holding period return. What is it called as? Holding period return. What is the meaning of this? Simple. They use all fancy language. Logically think. I invested today by paying how much? 100. I hold it for how much? 2 years. Over a span of 2 years, my investment has grown by how much? Can I say 125 minus 100 divided by 100? Of course, during this period, year 1 and year 2, if you would have received any dividend, that also should be added. Can I say plus D1 plus D2 also, because this is not a per annum figure. This is the total return earned across 2 years, not per annum. Is this clear? Now, when will you use this formula? When they're asking you for something called as holding period return. The return that you generated for the entire holding period is called as what? Holding period return. Is this clear, guys? Exam questions have also been there. I mean, recently they've asked some exam questions relating to holding period return also. Generally, if nothing has been mentioned, what will you take? Return means per annum basis only. If they are specifically mentioning, it is going to be what? A holding period return. In between what is P1 is not at all required. Starting value and the ending value are alone required, plus the cash flow that you generated throughout this entire time that you held the security. Is this clear, guys? So here, come back to the concept decoder. Here I would have given something called as doubt busters. Here, look at this. Here, holding period, can I say, is equal to Pn. N stands for what? The number of years for which you are holding. I held for 4 years, sir. So the price at the end of 4th year minus P0, that is the beginning value. This gives you the overall capital appreciation, plus what have they mentioned here? Dividend received from year 1 to year 4. Sir, each of the 4 years I received, sir, 10 rupees, 12 rupees, 5 rupees and 0 rupees. Add everything. And everything should come here. Is this clear? Why? Because we are not calculating per annum. We are calculating the holding period return divided by the initial investment. Is this clear, guys? Are you all able to understand? Now, if they have suppose given the holding period return in the question, and they are asking you to calculate the per annum return, very simple, no? So now, if this is the overall holding period return for 2 years, per annum, how much is it going to be? Into 1 by 2. Is this clear? That's what we have sent to 1 by n into 100. So this is what? To convert the holding period return to annualize the return. Is this clear, guys? Are you all able to understand? But of course, here what we have done, let us say, here guys, what was the holding period return here? In this case, it was how much? 25 percentage. It is 25 percentage. Guys, correct? It is 25 percentage. Am I right? Which means 100 rupees became how much? 125 over a span of 2 years. So 25 percentage was the return I earned, not in a single year, for 2 years. Per annum, how much is it going to be? So 25% by 2, it is going to be how much? 12.5%. Is this clear? Now wait. This is applicable provided if you are following simple interest formula. You guys know the concept of simple interest and compound interest. Now when you are investing 100 rupees in FD, right? Let us say 10% return. Now, at the end of year 1, the value will be 110. Now, in the second year, this entire 110 will generate another 10%. Is correct? And then that will become much more than that. Are you all able to understand? Which means you guys know that formula, right? The compounding formula and all. You guys know that? No? So here, you guys are aware of that or not? So we will say in this case, it is 100 into 1 plus r, the whole power n is equal to the future value. Guys, you all able to understand? Here I will say 100 rupees, right, reinvested at the end of first year again, and at the end of second year again, at the end of third year again, and so on, became 125 rupees at the end of the life, right? Which means how much is going to be my effective rate of return. This is what is called as compound interest formula. Do not worry, we will be seeing this in time value of money concept, but all the numerical problems in this chapter, ICAI only follows simple interest formula. Is that clear, guys? I am just opening up this thought for you. This will be covered in detail in the time value of money concept. Do not worry. All the numerical problems, ICAI has done it only based on what? Simple interest formula. Total holding period return divided by the number of years, you get per annum figure. Is that clear, guys? Deal? Simple? Till now, are you guys facing any issues? No. That's about it. I'm trading very slow because no, that's the way to actually enter into the subject. Slowly we will pick up pace, not a problem at all. You guys are clear with this? Right. Now, sir, yes, we know how to calculate the return per annum, right? So in the first example, we saw the return we calculated, it was how much? 15%. Second example, how much was the return? Minus 15%, right? And like this, we saw even the concept of holding period return. Is this clear, guys? Is this clear? Now, set this aside. Sir, when I am investing in a security, I am going to purchase a share. You will have an expected return. You will have an expected return. If I am investing in this particular share, how much return is something that I am expecting out of this investment is called as expected return. Now, how will you calculate that expected return is what we are going to see right now. Is this clear? So first we saw what? How to calculate return. Now we are seeing how to calculate expected return. What do you mean by expected return? If you invest in a particular instrument, what to expect from it is called as expected return. Is that clear, guys? Now, this expected return can be calculated from two different perspectives. It can be an average of past returns, or it can be an average of future returns. What is it? My expected return can be what? Either an average of past returns, or it can be an average of future returns. What it is, I will tell you, don't worry. Shall we get started, guys? Shall we get started? Yes. Now, let me just take an example. Let us say the stock ITC, right? In the last 3 years, how much return did it generate? Let's say year 1, year 2, and year 3. In year 1, it generated 10%. In year 2, it generated 15%. In year 3, it generated, say, 20%. Is this clear? Is this clear? The last 3 years, every year, it would have generated different returns, no? Exactly will it give you the same return? No. Now, each and every component of return, how did you calculate? Using the formula that we just saw right now. What is that? P1 minus P0 plus D by P0. Is that clear? Are you all able to understand? Every year, each of these figures were arrived using the base formula that we saw. Now, I have 3-year data, guys. Now, what is the expected return from ITC? Well, take a simple average of these 3. Is that clear, guys? Now, what is the simple average of these 3? If you add up how much you get 45%. So, the average return, the expected return, can I say, how much is that going to be? The expected return is going to be 45% on 3. It's going to be how much, guys? 15% is my expected return. Is everyone able to understand? So when you have a past data, take a simple average of past data and call it as what? Okay, which means from this company, I can generally expect what? 15%. Is everyone able to understand this? Simple, isn't it so? Next. Sir, what is this average of future returns? Now, future data, is it available with us? First of all, our subject financial management, is this subject a futuristic subject, or do we refer to the subject after entering into a transaction? Wait, let me clear it once again. This is the difference between accounts and finance. In accounts, after a transaction happens, you record it in the books. Am I right? Whereas in financial management, before entering into the transaction, you first decide whether to enter into the transaction or not. So here it involves what? Decision making. So basically, we actually, whatever we see in this subject, right, we are not recording any past data. We are taking decisions for the future. Agreeing with me on this? This is the core of the subject. Right, guys? Now, in the next year, what is the return that I can expect? Now, guys, for the purpose of average of future returns, we need to use the concept of probability. Sir, can you explain how this works here? Now, let us say next year there can only be three possible scenarios. What are the three possible scenarios? The market can either grow, there can be a growth in the market next year, or the market can remain static. Means what? Not much, neither growth nor a decline. Or in the next year, there can be a decline. Is that clear, guys? Now, if the growth happens, I know that this company will give me roughly about 20% return. If it is going to be static, not much of movement, maybe it will give me about 15% returns. And if there is going to be a decline, then in that case, maybe I can expect, okay, I'm not using the same figures. I'll say, let's expect about 5% return from this company. Is this clear? Now, in this case, you tell me, sir, there are three different figures here. Now, out of this, what to expect? The doubt is there or not? Now, this is why we use the concept of probability. When will we use probability? When there is some kind of uncertainty element involved. Now, let us say, an expert is saying, an economist is saying, the chances of growth for the next year is 60%. I will say it's 0.6. The chances of the economy remaining static is 10%. I will say it's 0.1. And the chances of my economy declining in the next year is going to be 0.3. Is this clear? So now what will be my expected return for the next year? I will say it's 20%, but the chance of this happening is only 60%, right? So 20 into 0.6 plus 15 into 0.1 plus 5 into 0.3. Is this clear, guys? Well, able to understand why? The next year, can you definitely expect 20%? No. The chances of you expecting this is only 0.6. So you multiply with the weights. This is nothing but a weighted average method. And if you always notice, you guys know, right? The sum total of probability is what? Always equal to 1. Are you all able to understand? Which means the next year, what is the return that you can expect? I will say it's going to be 20% into 0.6 plus 15% into 0.1 plus 5% into 0.3. Is that clear, guys? Can anyone help me with the figure? How much is that? Yes, it's going to be what? 15% exactly, yeah? Okay, guys, here it is matching. Here it is matching. Don't think it will always be equal. Coincidentally, it is matching. I didn't want to take the same figure. Had I taken 10, it would have been different. Coincident, I just gave some random figures here. But remember, when you are dealing with futuristic data, you use what? Probability. Are you all able to understand? So there are two ways in which you can expect a return from a company. One is by way of past data, which generally involves a simple average. If you're touching future data, it involves what? A weighted average. Is this clear for everyone? Are you guys able to understand? Is there any issue here? Guys, clear with this? Right? So till now, what have we seen? I'm just consolidating once again because we will be entering into some core level of statistics. So before that, let's actually consolidate once. So first, we saw how to calculate a return for each year. By the way, we also saw a concept called holding period return. If that is given, we know how to convert it into per annum figure. Is that clear? Next. Now, how do you calculate expected return? Two ways of doing it. One is using your past data, the other one is using your future data. If past data is given, so 3 years, 5 years, 6 years, whatever figure is given, simple average and say generally this is what you can expect from the company. If your future data is given, in that case what will you do? You use weights. Weights is nothing but your probability. Take a probability weighted average and to arrive at your expected return. Is this clear, guys? Now sir, this 0.6, 0.1, 0.3 probability weights, how to calculate? No one can calculate probability. That's why I said these are given by industry experts. In exam it will be given in the question. You can't calculate probability. It is actually, it involves some level of judgment. Okay, this is what I'm expecting, and these guys will give a justification for that also. It can't be calculated. Are you all able to understand? Done? Right? Shall we proceed forward to the next one called as risk? So till now what we are studying is a single securities return is what we have seen. Now we will move to the next concept called as single securities risk. We have seen single security return. Now we will see single security risk. Is this clear, guys? We have not yet entered what? The portfolio concept. First let us do single security, and then we will get into what? Multiple securities, which is portfolio. Are you all able to understand? Any issues? Great. Now let's go to the concept of risk. Single security risk. Single security risk. Please take the heading. Single security risk. Now, what do you mean by risk? I just told you the chances of your expectation not getting fulfilled. That is called risk. Now, I will give you an example of two different shares, and you guys tell me based on your observation which share is riskier. Can we do this? Yes. Now let's say there are two shares. Once again, ITC and HUL, Hindustan Unilever. Both these companies are into FMCG business. ITC is into, once again, your FMCG, your classmate notebooks. Yesterday we saw classmate notebooks and Ashirwad Atta, Sunfeeds biscuits and all that. HUL is once again, these guys are also into this Brook Bond, Three Roses, yes, shampoos and all these things, right? Okay, guys. Now let us say ITC's last 3-year returns are as follows: year 1, year 2, and year 3. The same example that I gave you: 10%, 15%, and 20%. Is that clear? Now, how about HUL? Guys, these are not actual figures of ITC and HUL. I'm just giving you guys an example. Now, how about HUL? Let us say in year 1, it gave -5%. Can return be negative? We just saw. Yes, very good. Next, year 2, it gave a 10% return. And year 3, it gave what? A 40%. Now, you guys tell me, looking at these three shares, these two shares with 3-year data, you guys tell me ITC, HUL, right? Now, in this case, first of all, you tell me for ITC, what is the expected return? Can I say this? The total here is 45%, and can I say the expected return here is going to be 45 divided by 3? How much is it? 15%. HUL, what is the total here? -5 plus 10 plus 40. Now, again, the total is 45. Deliberately I've kept it. Okay, so here the average here is going to be what? 45 by 3. How much is it? 15%. Now, when you invest in ITC, you are expecting a return of how much? Hello, come on, guys. What is the return you're expecting? 15. Year 1, 10. Year 2, 15. Year 3, 20. Or in other words, here the range of return is what? 10 to 20. Am I right? Whereas, if you invest in HUL expecting the same 15%, in 1 year it can be -5. Another year it can be 40 also. Is that clear? Now tell me, between the two, which is more riskier? HUL. Why? The volatility is more. It can deviate from my expected return by a high margin. Guys, getting it? Now, it can also be way less than what I expect. It can also be extremely more than what I can expect. This is why I'm saying return is not equal to loss. Risk is not equal to loss. Risk is not loss. Risk refers to what? Again, the chance of your expectation not getting fulfilled. That's about it. It can be downside, it can be upside. Is that clear? Is that clear? So between the two, are we on a clear agreement that this company HUL is riskier as compared to ITC? Guys, getting it? Why? The volatility is more. The deviation is more. Is that clear? Deviation from what? From what I expected. Are you all able to understand? So now, sir, we understood that HUL is riskier. But how to calculate risk and put it into a number is what we are going to see right now. Now, for this purpose, we will be using a statistical tool called as standard deviation. Is that clear? What are we going to use? The concept called as standard deviation. Now, how do we use this standard deviation? Guys, please focus here. I will tell you. Now, guys, first we will compute for this company ITC. Yes, we have 3-year data. What is it? 10%, 15%, and 20%. Now, guys, now here, what is the expected return? Can I call this expected return as the arithmetic mean? It is nothing but average, simple average. So here in statistics, we call it as X bar. What is it? X bar. You guys have seen this? Yes, in your foundation itself, it is covered, right? X bar is nothing but a simple average, mean. Are you guys able to understand? How much was the mean? 15%. That is what we call as our expected return. Is this clear, guys? Now, here I will call this as X. X refers to what? The actual return in each of the 3 years. Now, each year, can we try to find out by how much every year's return has deviated from its average? So, can I say X minus X bar? Can we calculate this? Guys, here in year 1, how much was the return? 10%. But how much was my expected return? 15%. So, here can I say 10 minus 15%, right? By how much it has deviated is what we are trying to calculate. Is that clear? Because that is what we want to know, right? That is called as risk, right? Guys, are you all able to understand? So the first year's actual return was 10, but expected was 15. So X minus X bar, how much is that? How much is that? Minus 5%. Year 2, actual was 15, but expected was 15. So how much is it? 0. So exactly in year 2, there was no difference at all. Is that clear, guys? In year 3, 20% minus 15%. How much is that? 5%. Is that clear? Now, if you add the 3, how much will you get? You'll get exactly 0. Why? Mathematically, you guys must have studied this in your foundation. Arithmetic mean stands in the center of your population. And hence, if you add the differences, obviously it will be equal to 0. Are you all able to understand? Now, can I say the risk is 0? There is no risk. Huh? Can I say there is no risk here? Absolutely not. You can see the volatility. All able to understand. Hence, what we do, why are we getting 0? Because we are having a negative figure here. We are having a positive figure here. Hence, to avoid this, what we do, we square it. Are you all able to? Literally, I'm teaching you the logic behind calculating standard deviation. Ideally, all these things are a part of your foundation. Are you all able to understand? Right? So what we do here, the next step is that we calculate X minus X bar, the whole square. Are you all able to understand the logic? If you just do this, it will only be 0. Sir, I can see the risk, but your answer is 0, sir. Cheating, no? So that's the reason mathematically we square it first. Are you guys able to understand? So now what is this? Come on, guys, quickly, come on, tell me the figures. It's going to be 25%. 0 and 25%. Add it up, you get how much? 50%. Now this 50, right, is for sum total of 3 years, which means per annum. On an average, how much is this? Can I say it's going to be 50% divided by 3? How much is it, guys? 50 by 3, come on, do it. How much you get? So you get 16.67%. Guys, correct? Now can I say this is the standard deviation or this is the actual risk? No. Why? Here you squared it. Guys, the actual deviation was only X minus X bar. But if you add it up, you get 0. To avoid this, what you did? You squared it. And then you totaled. Since you totaled, you took an average. Since you squared, now you need to take a square root here. This is the reason why we always say standard deviation is square root of this particular figure. Are you all able to understand? This is the logic, guys. Now, whoever said statistics was difficult, this is about it. This is about it. Are you all able to understand the logic why we are doing it step by step? Because this entire subject, I mean, this entire chapter revolves around statistics. That's the reason I'm trading extremely slow. Even though this is a part of foundation, don't think I'm very much aware. Okay, guys, clear? So now, what is going to be, you know how standard deviation is represented? It is represented like this. You guys are aware of this? Yes, so standard deviation, this is how it will be, right? Or we can call it as SD. Standard deviation is equal to what? Square root of what? 16.67 percentage. How much is that, guys? Take a square root here. Roughly it comes about 4.08 percentage. Okay, we can stop at 2 decimals here. Are you all able to understand? Are you all able to understand? Any issues here? Any problem here? Guys, are you getting it? Now let's do this. Can we do it for HUL now? Let's do it together, guys. Have this practice. Do it along with me, right? So that we will be solving numerical problems as well. Plus, get the habit. Shall we do it? Yes. Let's get started. Now we are going to do this for HUL. Come on, guys. Come on, do it. What are the returns? Write down your 1, 2, 3. By the way, I know my handwriting is very bad, but it is legible, right? You can understand. So this was one strategy I developed. So in exam, the problem is, earlier I used to scribble a lot. Then I had the fear, what if the examiner cannot understand? So what I did was I started writing it a little bigger. So from then onwards, I'm habituated to that. So I know my handwriting is not neat, but I hope it is legible, right? Yes, I've tried a lot, but of course, now we all work in systems, computers only, but anyways, I hope this is legible. Okay, guys. Now we'll take here, it's going to be what? Let's call this as Y, because it's another share, we will call it as Y. Right, what are the 3 years return? Come on, tell me. -5, 10, 40%, right? And come on, Y bar, what do you mean by Y bar? Average, arithmetic mean, right? Expected return, how much was that? We calculated already. Same, 15%. Next, what will you do? Come on, I want the answers from you all. Learn like a child. Yes, Y minus Y bar. Why are we calculating this? What are we doing? What concept are we in? Risk. Risk means what? By how much is my actual deviating from my expectation? This is actual, this is expectation. That is what we are calculating. Is that clear? Tell and write, it stays with you for a lifetime. Right? Don't mug up anything. I keep telling you this, mugging up is not even a sin, it's a crime. You cannot mug up, right? Come on, do it. So it's going to be what? -5%, -15% comes out to -20%. Then 10% minus 15%, how much is that? -5%. Then 40% minus 15%, how much is that? Positive 25%, right? Now if you add up, you need not add, you already know, it will only come to what? 0. So now what will you do to avoid this? Standard deviation, squares. So Y minus Y bar the whole square. So 20 square. You guys know how to square in your calculator? You guys know the shortcut? 20 into is equal to you do. That's about it. Guys, for those who do not know, 20 into is equal to you do, you will get it. Is that clear? Right? So 20 into is equal to, how much you get? You get 400. Then here 25 and here 625, add up 1050. Now you tell me. So now what will you do to this 1050? Direct square root. No, this is total, right? So 1050 divided by what? Divided by 3. How much is that? Yes, you get what? 350. Guys, this 350 figure is there, no? What is it called? It is the square of standard deviation. Square of standard deviation. Actually, square of standard deviation is called as what? Variance. In statistics, we call it as variance. Many of you should ideally know this because it is in your foundation, in fact school also, but anyways, let's not go to that level. Okay, guys, so this is what? 350 is what? Standard deviation. 350 is what? Your variance. Now what is my standard deviation? Since I totaled here, I took an average, but since I squared earlier, I now need to take a square root, right? So now my standard deviation is going to be equal to square root of 350. How much is it coming out to? Roughly about 18.71%. Is this clear, guys? Are you all able to understand how to calculate standard deviation? Is there any problem here? Is there any problem? Any issues? Any problem here? Clear with this? Easy only, no? Simple. The beauty here is only if you know why you are doing whatever you are doing, you will love the subject like anything. The problem is we are used to this rote mugging up. Okay, standard deviation means step 1, step 2, step 3, final answer you will get. Why are you doing it? That too, this is a mathematical concept. I'm linking it to the concept of risk and explaining it to you why we are using it in finance. Are you guys able to get the step by step logic here? Getting it? Clear? Great. Now, fine, sir. We got this. Let us put this as one table. Now, what were the two shares, guys? Come on, tell me. I need your help now. Come on, guys. ITC and HUL. X bar standard deviation. You guys tell me. ITC, what was the expected return? 15%. What was my standard deviation? 4.08%. How about HUL? 15%. What was my standard deviation? 18, no? 18.1%. Now, first, before I get into which stock to, which is preferable, which is a better stock and all, let's do that in a while from now. First, many of you must be having this doubt. Sir, let us take this ITC example. Let us take this ITC example. Now, here in ITC, 15% is what? Expected return. This we understood. What is this? This is what you are expecting from this company. You said risk is how much? Standard deviation. How much is that? 4.08%. What does it mean? What does it mean? How do you interpret standard deviation? Now we saw how to calculate standard deviation. Now, you said something risk, for that you said this is standard deviation, is a statistical measure. We agree. How do you interpret standard deviation is what we are going to see right now. Now, what does it mean? For our example's sake, can I take this as roughly 4% approx? Okay, just for the sake of explanation. Now, can I say, what is my expected return? 15%. I'm saying the standard deviation is what? 4%. Means what? You can expect 15%, but the actual return will be 15 plus 4 or 15 minus 4. Is this clear? But wait, I'm not done it. Please, 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 please focus here. Right? So here can I say we are trying to build a range. Are you all able to understand? So here can I say the actual return can be what? 15 plus or minus 4%. In other words, can I say your actual return, your expected return is 15, but the actual can range somewhere between 15 minus 4 is how much? 11%. To 15 plus 4 is how much? Is this clear? Is this clear? I am not done yet. Wait. Now, ITC shares, can you tell me each of the 3 years? 1, 2, 3. Each of the 3 years, what was the actual returns? 10, 15, 20. Now, based on the concept of X bar and standard deviation, I told you we can build a range. Now, sir, are you 100% sure that my actual return will definitely fall within this range? Are you actually 100% sure that my actual return for each of the years will definitely fall within this range? Statistics says no. I am roughly 66% sure. What is the 66% sure? I will tell you. More details we'll be seeing in a chapter called risk management, but for the time being you just understand this. Now, statistics says I am 66% sure that your return, actual return, will fall within this range. Are you guys able to understand? What is that 66% sure, sir? How did you get that fancy number and all? Now, right now at the moment, I will just give you a bird's eye view about this concept. Detailing will be done in a chapter called risk management, the third chapter that we are going to do. Is that clear? Now, mathematically, you guys have heard something called as normal distribution table. Somewhere you have heard something like that. Now, mathematically, they are saying that whatever data of actual return that you give, now we took 3-year data, right? If you want, you can even take minute by minute data. Market, every minute the value changes. When P1, P0 value changes, obviously the return calculation also changes. We are doing here 1 year, one value we are taking. Every minute you can take a value actually. Why? Every second also you can take. Are you guys getting it? So the data set can be huge. Instead of 3 figures, I can even have 10,000 figures here. Based on that, I can do the calculations and do. Are you all able to understand? If you put all those 10,000 figures in our example here, they are saying it will form a bell curve, is what statistics says. Is that clear, guys? It will form what? It will form a pattern. If you plot this on a graph, this is how it will look like. Are you all able to understand? Sir, exactly will it look like this? This is called Norman distribution table. The data gets distributed like in a bell curve format. There can also be other distributions like Poisson distributions and all. Let's not get into deep into it. I am just trying to give you guys a bird's eye view. Is this clear, guys? So simple, in simple words, if I actually plot all the actual data, it will form what? A bell curve pattern. Is that clear? Something like this. And in this entire data set, right, my mean stands in the center. In our case, it is X bar. Is that clear, guys? Now what they are saying is, I'm taking X bar. We calculated standard deviation. Now in our case, what was standard deviation? 4%, right? Now they are saying, so the actual return can be what? X bar plus 4% or X bar minus 4%. They are saying, which means this is the range you're talking about. Are you all able to understand? Now they are saying, in this range, only 66% of the data will fall. This is what they are saying. There are possibilities that the data can also fall beyond this range. So that's why statistically they are saying the confidence level, this is what they will say. I'm 66% confident that the data will fall within this range. Are you all able to understand? Are you all able to understand? Because there are also chances that my data can fall outside this range. Guys, correct? Correct? We have seen here itself, you see, you have a figure called 20%. It is beyond what? 19%. Are you guys able to understand this? Why, how, we will be seeing in a separate chapter, but I know this will bug your head. We saw how to calculate standard deviation, but how to interpret standard deviation is one thing that you guys need to know. Is this clear for everyone? Are you guys able to understand this? Are you guys able to understand this? No. No, sir. 66% confidence level and all is not sufficient. Tell me, sir, 100% confidence level means 100% sure. To give me a range within this only should fall. No one can be 100% sure. But here they say, under the normal distribution concept, they say 99.99% I can give you a confidence level, right? So 99.99% confidence level, then in that case, sir, what will be the range? You will be seeing later, not right now, but just because this concept came in, I'm telling you, they are saying in that case, if you want to build a range, it will be X bar plus or minus 3 times the standard deviation, which means here we took only one standard deviation, take three times the standard deviation. Now it covers more data. Now within this range, I'm 99.9% sure your actual return will fall. Are you all able to understand? So this is something that we will be seeing in a concept called value at risk later on. But I wanted to do this right now because you should know why we are doing whatever we are doing. Are you guys getting this? Are you guys getting this? So don't say that my actual return will fall only in this range of X bar plus or minus standard deviation. Chances are only 66% mathematically. Why 66%? We will see later also. Is that clear? There is a normal distribution table. I will plot and show it to you. Are you guys able to understand? Any problem till now? So as of now, what we did, we first started off with a concept called calculating per annum return. Guys, P1 minus, come on, P0 plus D upon P0. Like that year on year we calculated, right? Next, how to calculate expected return. 2 different methods. One is simple average if there is a past data, weighted average, probability weighted average if there is a futuristic data. Next, we went on to the concept of risk. And risk, what is the statistical measure of risk? Standard deviation. How will you compute? First, X figures you write. Calculate the arithmetic mean, basically the average, right? X minus X bar. But since the total will be 0, we will square. So X minus X bar, the whole square. Total it. And this total should first be divided by 3 or whatever is the number. Average it out. Whatever you get is called as variance. And since you squared earlier, now you root it. Whatever figure that you get is called standard deviation. And how do you interpret standard deviation? X bar plus or minus standard deviation will give you a range, but the actual return falling in this range is only 66%. If you want a better confidence level or surety, confidence level is surety, right? In simple words, then maybe you should take more number of standard deviations to increase the range, and mathematically how to do that we will be seeing in a later chapter that is not covered in this chapter. Are you guys clear with whatever we have covered till now? Guys, this is the way to learn the subject, because this forms the core of it. In a few other chapters we'll be using standard deviations and all. Easy, no? Easy, no? Know the logics and do it. Fine, guys, are we done here? Are we done here? Great. Okay, cool. Now what we'll do is, one second. Okay, shall we do one numerical problem? Shall we do one numerical problem? Wait, I will give you an example. This is not there in the study material or anywhere, so I just wanted to give you guys a numerical problem, so that I will write it down here. Please write it in your notes. We will solve it together. This is actually a summary of the entire discussion we have done till now. Shall we do it, guys? Shall we do this? Please write this down, because this gives you a lot of confidence. Now guys, once again I'm telling you, don't think we are going slow in case you feel so, because remember Abraham Lincoln saying, what is that? If you give me 6 hours to chop down a tree, I will spend the first 4 sharpening the axe. We are sharpening the axe, and you will see this by yourself. We will not be taking much time while solving numerical problems. If we don't spend time here, throughout the subject it will be a problem. That's the, people think they are doing it smart and they do it a little fast. It doesn't work that way. You should know where to be slow. You should also know where to be fast. Once learning everything, then if you continue in the same pace, that is also not good. Is that clear? Shall we do it, guys? Now I want an active participation. And online folks, assume I'm standing in front of you, right? And just answer back to the screen. Even if the people around think you are stupid, it's absolutely fine. Don't bother about it. You have to get the best learning experience. Stay focused on that. Shall we begin, guys? I'll give you a numerical problem. It's a summary of whatever we have covered till now. Right? Shall we get started? Perfect. Take down this example. Right? Write down. Example. I'll give you a data set. Okay? Right. Here, dividend per share, DPS, and market price per share, MPS. 0, 1, 2, 3, 4, and 5. What is the dividend here? Year 0, 1.53. Year 1, 1.53. Once again, 1.53. 2.00, 2.00, and 3. Is this clear? So dividend for each of the 6 years, year 0, 1, 2, 3, 4, 5 are given. Right? I'll take it as 2020. This will confuse, that's why. Take it as 2020, year 2020, 2021, 2022, 2023, 2024, and 2025. Take it as follows. Okay? Else it will confuse. If I take it as year 0, then you will think it is today and all. Okay, let us do this. Okay, then market price per share, MPS. Take this. It's 31.25. I took it from a very old source, long back. Earlier it was there in the study material. I don't know why they removed it. Anyways, 20.75, 30.88, 67, 100, and 150. Right, guys? Now, what do you need to calculate? Calculate the annual rate of return for last 5 years, and they don't stop here. How risky is the share? What is the meaning, guys? How risky is the share? What are they asking you to calculate? Standard deviation. Is this clear? Have you guys noted it down? Right? Shall we get started? Shall we get started? Okay. Write down. Let's do this. First, what will you do? Guys, 1 second. Wait. First, build the approach. Now you tell me, even if they have not given last 5 years, you can only calculate the return for 5 years. Why? For the first year, you need what? P1 minus P0. So this is the base. So from here only you can calculate the difference. Am I right, guys? So which means For 2021 to 2025 only you can calculate. Guys, are you all able to understand this? Yes. So which means this 1 year has to be the base for you. Of course, this figure is not relevant. This figure is relevant. Is that clear? Now, based on this, what will you do? Year-wise, first you will calculate what? Your return. Now you have a 5-year data. Now with this 5-year data, what will you do? Calculate the standard deviation. For you to calculate the standard deviation, automatically you need to calculate expected return, because standard deviation means what? From the expected return by how much is my actual return deviating. So which means for all your standard deviation sums, invariably the starting point itself is expected return only. Are you all able to understand? Deviation from what? Your expectation only, no? So even if a sum is only about standard deviation, it obviously includes return calculation. Are you guys able to get this? Let's do this. Come on. Let's do this. First, write down. Quickly, guys. Let's write down. Return. Write down. Expected return. 1 second. 1 second. You guys have finished intermediate for sure. In inter, we have something called as KE. What is KE? Cost of equity. Right? What is cost of equity? Cost of equity is not, for those who do not know, cost of capital, that entire chapter, is not what the company actually pays. What you actually pay is recorded in accounts. In finance, we are not bothered about the actuals. We are bothered about the expectation of the investor. So can I call this expected return as KE? Guys, obviously yes. Are you all able to understand? Yes, we can call it as KE, no problem at all. Now, going forward in a concept called CAPM, we'll be seeing, yes, we will be using only, KE. You guys know CAPM formula, or at least have heard of CAPM? We will be seeing that as the next segment. That will be saying KE is equal to only, it is given, no, RF plus beta times RM minus RF. What it is, we'll be seeing later. But why is suddenly KE? Expected return. He gives another way of calculating expected return. So it's all the same. Guys, clear with this? So let's do this. Let's do this. So this is how your inter and final is linked. So of course, K stands for cost. Cost is generally from the perspective of company, but still, it is an expectation of your equity shareholder. You can call it so. Now write the formula. What is it? Tell and write. Come on. P1 minus P0 plus D divided by P0 into 100. Now quickly, guys, for each of the 5 years, shall we do it? Yes. Now once if you write the formula, it's enough, right? Now let's do the calculations. First one, what is it? 2021, huh? 21 only, no? Yes, 2021. Come on, give me the figures. What is it? So 20.75 minus 31.25 plus 1.53. This second 1.53. We are not bothered about the past year. Is that clear? Upon what? 31.25, because that would have been, this was the closing price of the last year. Obviously, this is the opening price of the current year. Is this clear, guys? Yes, that is the base price. Come on, do it. Give me the figures. It's going to be what? 20.75 minus 31.25 plus the current year dividend 1.53 upon 31.25 into 100. Figure. 28.70 within bracket, without bracket. Negative. So, or you can put it as minus 28.70%. Is this clear? Next one. 2022. Guys, come on, do the calculations. Figure, tell me. 30.88 minus 20.75 plus 1.53 divided by 20.75. Am I right? Come on, do it. Quick. 30.88 minus 20.75 plus 1.53 upon 20.75 into 100. Figure. Come on, tell me. 56.19. Okay, 2 decimals is generally enough. Right? Actually, guys, some students ask me this, sir, how many decimals should I take? Guys, there is actually no clarity by ICAI regarding this. At times they take 3 decimals, 4 decimals, 2 decimals. Generally, we can follow, in chapters like Forex, foreign exchange, I told you, there, and also whenever time value of money is involved, present value factors and all, generally you take 4 decimals. In all other areas, it is up to you. You can take 2 decimals or 3 decimals, not a problem. Is that clear? There is no clarification by ICAI. We can use something which is logical, but remember in those 2 areas, it is 4 decimals. Anyways, I will tell it to you again in that point of time. Next, 2023. Guys, come on, pick up the pace now. Pick up the pace. 67, tell and write, minus 30.88 plus 2 upon 30.88 into 100. Figure. 123.45%. Right? Next, 2024. Yes, 100 minus 67 plus 2 upon 67 into 100. Figure. Quick, quick, quick. 52.24 is it? Yes, come on guys, slowly pick up the pace. These are known areas. Let's do it quickly. Last year, 2025. 154. Come on, tell and write. Minus 100 plus 3 upon 100 into 100. Figure. 57%. Is this clear for everyone? Is this clear for everyone? Right? Now what will you do? Put it in that dabba and as usual have a template for calculating what? Your risk. Shall we do it? Yes. Now write down, take a heading. I told you heading should be in green ink. Write down calculation of expected return and risk within bracket standard deviation. Shall we begin? Shall we begin? Yes. Year, then return this x, then what will you do? The third column, come on, tell. Yes, x minus x bar, then x minus x bar the whole square, right? That's about it. Now remember guys, now since we are the initial sums, I'm doing this column, right? Going forward, this is not required. Even for exam, we'll directly go with this. Is that clear? Right? Basics we are doing. That's the reason I'm also walking you through this. Let's get started. Come on, what are the years, guys? 2021, 2022, 2023, 2024, and 2025. Figures, come on. I want you guys to consolidate and tell me the figures. Yes, come on. Negative 28.70%, then 56.19%, then 123.45%, then 52.24%, then 57%. Yes. Total this up. How much are you getting? How much are you getting? Quickly, come on. Tell me how much is the figure? 260.18. This is the total. Now immediately what will you do? Can you go to the next column? No. First you should calculate x bar. What is x bar? Expected return. Come on, tell me guys. X bar is equal to, yes, how much by how much? Okay, now guys, x bar, there is a formula which they have given. Can I say it is sigma x divided by n? What is sigma x? The total of this column. Divided by n means number of years. Correct? I'm giving a mathematical formula for this. It is simple logic only. Guys, correct? In exam, they are expecting you to write it. But logic is only this much. You guys are clear? Right on, what is this? It's going to be 260.18 upon 5. And how much is that? It's going to be 52.036. Okay, round it off to 0.04%. Is that clear? Now what will you do? Come on, guys. Calculators. Come on, use it. Minus 28.7 minus 52.04. How much you get? Minus 80.74. Guys, this is not a positive figure. Minus and another minus. So literally the sum total of this will be the minus. Is that clear? Next one. 56.19 minus 52.04. How much is it? Come on. 4.15%. Correct? Guys, what happened? Simple mathematics only, no? Next one. Everyone, I want every single one of you to participate. Tell me, guys. 71.41. Then 0.2%. Then 4.96%. Is that clear? There is no point in totaling it. We know, right? Then what will you do? Square it. Come on. How will you do it? 80.74 into is equal to, figure. How much? 6518.95. Is that clear? Then 4.15 into is equal to 17.22. Next, 71.41 into is equal to 5099.39. Very good. Next, 0.2 into is equal to 0.04. Next, 4.96 into is equal to 24.60. Add it up. How much you get? How much? ಇಲ್ಲ 560 boss, you left it this. இங்க ஒரு 5000 you have, இங்க ஒரு 6000 you have, இதுவே 11000 வந்துரும். 11,660.20. Correct? Correct? Any problem? Now one second. Please. Now guys, what you guys did, you squared everything and finally you guys added. There is a calculated trick to do it. Yes, M plus you can use. How to use it for those who do not know? If you already know, well and good. Now take your calculator. First, that MRC button is there. No, click it twice. You are clearing the memory. Now, what is the first figure that you need to square? 80.74. Do exactly what I say. Exactly to the point. 80.74 is there. Click into. Now, instead of is equal to, click on M plus. Right? Automatically, what will happen? It will total and add it to the memory. Second figure, once again you do. Now, you need not do anything. Next, clear it. Then 4.15 into M plus. Okay, then clear it. Next 71.41 into M plus. Then 0.2 into M plus. Then 4.96 into M plus. Then finally click on MRC. What do you get? Exactly, you'll get this figure. Saves a lot of time in exam. Why should you do this laborious work? I will explain for those who didn't understand. Simple. First, in your calculator, there's something called M plus, M minus, MRC. M minus we are not using. Click on MRC twice. It means you are clearing the memory. Okay? That's when you will understand exactly. Now, you want to square this. And then, sum of all the squares need to be added. This is our objective. First, this figure is there. How do you square it? 80.74. Wait, 80.74 into is equal to, you generally do. Instead of doing into is equal to, put into M plus. 80.74 into M plus. Click into once. Click M plus once. Yes. Then go to the next calculation. Click on AC. Or clear this. Next, go to the next one. 4.15 into M plus. That's all. You need not do anything. Third, 71.41 into M plus. Then fourth figure, fifth figure, do for everything. And finally click on MRC once, you will get that final answer. That's about it. Everybody understood? Everybody understood or not? Guys, I thought many of you must be knowing, but anyways, for those who didn't know, it's okay, no problem. You learn it. That's about it. Guys, clear with this? Any problem, any issues here? No. So now what do we do? Come on, we know what has to be done. This is a total figure. Now what will we do? Once again, guys, once again, can I say this is nothing but sigma x minus x. This is not variance. This is not variance. By the average is only variance. So can I say this total is nothing but the total of this column? So sigma x minus x. Sigma means summation. Is that clear? Can I call this as follows? Yes. So can I say the standard deviations? I mean, your variance is what? Square of standard deviation. So my variance is how much? 11,660.20 divided by how many years were there? So divided by 5. How much was that? How much is it? 2332, right? 0 something, okay, 0.04 something, right? And the standard deviation is what? Square root of this. Just click on square root. How much you get? 48.29% roughly. Or can I say, guys, standard deviation is nothing but square root of sigma x minus x bar upon n. I'm just putting a formula to this. That's all we did know. Guys, this is nothing but sum total of this column x minus x bar, and we took an average of that. That is only variance. Square root of variance is only standard deviation. Is that clear? Are you all able to understand? That's about it. Is this clear, guys? And that's about this particular question. So they had asked for what is the expected risk. The risk is going to be this particular figure, 48.29. Is everybody able to understand? Is there any issues here? Guys, clear? Where? Yeah. Yeah, you have to put the square. Clear with this? Done? Any problem, guys? Any issues here? No? 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 Till now, what we did all these calculations based on simple average. Now, can we take up and do one question that involves weighted average? I mean, your probability weighted average. Can we do one sum regarding that? Okay. Now, please take your solved question bank. Please take your solved question bank. For those who have the hard copy, well and good. If not, right? You can download it from our website. So costfin.in, under the free resources, the entire PDF is available. You can happily upload it, download it, and you can use it. Okay, guys. Anyways, the initial pages I've written some message and all. Please do read it. And anyways, now let's get started. Which question? Okay. Please go to your page number 9. Test your knowledge. ICA question. Test your knowledge. Question number 1. Please go for it. Question number 1, ICI. TYK. Test your knowledge. Question number 1. Shall we begin? Shall we begin, guys? Okay. Now look at this. This is your study material question. Book back. Now, read it carefully. A stock costing 120 pays no dividend. Now wait, what does it mean? Which means the entire return is only your capital appreciation. D is 0. That's all about it. That's about it. No. Here, the possible prices that the stock might sell for at the end of the year with respective probabilities are given as below. Now, generally, when will we use probabilities? When we are expecting, predicting future. We are not dealing in past data. Is that clear? Now, 1, 2, 3, 4, 5, 6. They have given 6 different expectations. Now, what is this? This is going to be my P1 price at the end of first year. Am I right, guys? Now, I actually logged this. This is the price at which I paid and bought the share. Now, next year, by how much it will go? I don't know exactly. I have 6 different possibilities, right? And they have given the chances for each probability. The chances of each possibility happening. That is called as what? Probability. Is this clear, guys? So, which means this question you can't take a simple average. You need to take a weighted average. What is the weight? Your probability. Clear with this? So, probability is nothing but weighted average only. Is that clear? Now, what are they asking? Number 1, calculate the expected return. Number 2, calculate standard deviation of returns. Is this clear? Right? Now, I will give you about 30 seconds time. Quickly go through this once. Frame and approach the solution and then get started. Online folks, pause the video now. 30 seconds you take time, not beyond that. Read the question, frame and approach the problem, and then we will get started. This is something that I will do generally for all the questions. So take this time first, process it, and then we will get started. We'll do it together, exactly 30 seconds. Now, guys, how do we do this? How do we do this? Come on. I will show it later. Don't worry. Okay. Now, this is what question is this? Number 1, right? So please take the reference here. So this is TYK question number 1. Okay. Always, guys, give the cross referencing. So this is in page number 9 of the study material. Right? Page number 9. In your material, go give the class note page number. Is that clear? Always do this. The cross referencing is very important. Why? From the solution, you should be able to go to the book question, or from the question, you should be come back to the solution. Is that clear? And one more thing, ICA has presented it in a slightly different manner. Don't worry, we will be doing it in a much more logical manner, which you can follow in exam also. Is that clear, guys? Shall we begin? Shall we begin? Okay. Now, first, you guys tell me, what is the formula to calculate what your first year on year you need to compute the, for each of the 5 or 6 different outcomes they have given, we need to calculate what? The expected return. Am I right? So what is the formula for that? So expected return is equal to, yes, or return is equal to what? P1 minus P0 plus D whole by P0. Am I right, guys? Am I right? Is everyone able to understand? Any issues, any problem here? No. Now, year on year, not year on year in this case, it is going to be for each and every outcome, we need to do that. Shall we get started? Yes. So now, in the first case, they have given what are the different possible prices. So write down here. Let's put a dabba. First one, possible prices within bracket. This has to be P1. Am I right, guys? These are the different possibilities. What are the different possibilities here? 115, 120, 125, 130, 135 and 140. Am I right, guys? Am I right? And how much was our P0? We know on the top. P0 is equal to how much? We know it was 120. It is given in the question. That is the price at which I purchased. Guys, correct? So now the first thing, in this case, are there any dividends? No. So can I say the return has to be what? P1 minus, what is P0? 120. Can I put it as 120? Guys, correct? Plus. Can I put it as D? How much is it? 0. Right? And here I'll put it as return in rupees. Guys, getting it? Then we will divide it by the denominator. Is that clear, guys? Are you all able to understand? Now tell me, how much is it in the first outcome? If my price is 115, how much will be my absolute return? 115 minus 120. How much is that? So minus 5. Second, 120 minus 120, 0. 125 minus 120, 5. 130 minus 120, 10. 135 minus 120, 15. And 140 minus 120 is going to be 20. Is that clear, guys? So now, but remember, always we calculate returns as a percentage. Hence, what do we do? Simple here. So the returns as a percentage is going to be what? This figure, return in amount, divided by what? P0. Am I right, guys? Guys, that's what you do. Simple. These figures divided by 5, minus 5 divided by 120. How much is that? How much is it, guys? Into 100. So negative 4.17 roughly. Negative 4.17 percentage. Next, this is 0. Then you get same. Don't calculate again. So negative positive only. So here it becomes positive. Then 10 upon 120. I mean 10 upon 120 into 100. How much? 8.33%. Here it's going to be 15 by 120 into 100. 12.5 percentage. And then 20 upon 120 into 100. How much is that? 16.67 percentage. Is this clear, guys? So now remember, in this question, what have they given? In this question, what have they given? They have not directly given 5 different possible returns. They gave the 5 different possible price at the end of year 1. Hence, first step is to calculate the 5 different possible returns. And that's what we did right now. Is that clear? Guys, this is how I say can twist. Are you guys getting it? First step is what always make return as a percentage. We have not yet started the sum. Ideally, they should have given. We only actually calculated here. Is that clear? Is that clear? Now what will you do? We will have to go ahead and calculate what? First one, the expected return we need to calculate. Guys, now here, what will be my expected return? Can we continue doing it here? Now, can we continue doing it? Yes, you can put this here. Write down probability. What is the probability for each of these return getting fulfilled? Now, each of these return, what are the different possibilities given in the question? 0.1, 0.1, 0.2, 0.3, 0.2, and 0.1. Obviously, if you total, it has to be equal to 1. So now, guys, now, can I say the expected return will be how much? This into 0.1 plus this into 0.1 plus this into 0.2 plus this into 0.3 plus this into 0.2 plus this into 0.1. Am I right, guys? So here, will I actually get 4.17 negative? You might. The chance of that getting is only 0.1. Hence, the respective return into the respective probability you do and add it up, that itself is actually your expected return. Once again, don't take an average, because here we are taking an average here. Guys, ideally 0.1 is what? Can I say 10 divided by 100? Right? Ideally, this 10 divided by 100 is also factored here in the decimal. Hence, this itself, if you multiply and total, you get automatically the average. Many students once again actually take an average. They do divided by 6. Here, divided by 6 and all you cannot do. Are you all able to understand? Are you all able to? It is not a simple average. If you do that, it becomes a simple average. Are you all able to get this, guys? So here, we don't take sum total of this also and divided by 6. If you do that, it means you are giving equal weightage to all the 6 chances. So here we have different weightage for every single outcome, and hence what we do, we need to marry the 2 figures. We need to multiply the 2 figures. Is that clear? So now can we multiply these 2? So write down here, return percentage into probability. How much is it? Come on, guys, quickly. Minus 4.17 into 0.1. How much is that? Minus 0.417%. Then this is going to be 0. Here, 4.17 into 0.2. How much is that? 0.834%. Then 8.33 into 0.3. How much is it? How much is it? 2.499. Very good to see students getting quick calculations. 12.5 into 0.2. Come on, guys. 2.5%. Then 16.67% into 0.1. How much is that? 1.667%. Now total it up. How much you get? No. How much you get? 7.083%. Is this clear? Now can I say this is directly my X bar? Why? It is already averaged out. Don't once again divide it by 6. Is that clear, guys? Why? Because probabilities are weighted. The denominator is already considered here. Is this clear, guys? Are you all able to understand? Any problem, any issues here? Any problem, any issues here? Or in case of probability, can I say X bar is equal to sigma P into X bar? Guys, can I say, sorry, sigma P into X? Am I say this? That is, we are multiplying the return with the probability and there we are totaling it. Am I right? This is nothing but sigma Px. Right, guys? So in case of probability, can I say that the expected return is nothing but the multiplication of the respective return with the probability and adding it directly, guys? Or strictly speaking, mathematically, this is nothing but sigma Px divided by sigma P. Sigma P is what? Sum total of P is what? 1 only. Hence, we don't use this because this is 1 anyways. Are you all able to understand? Hence, this itself is actually your expected return. Are you all able to understand? This is one more formula given in your material. Should you mug this up? Should you mug this? Logical, guys. Very logical. Is this clear? If people look at the sigma and all, they look at it as if it's a zombie. Guys, this is simple, yeah. Nothing. Are you all able to understand? Any problem? Fine. So now what have we calculated? We have only calculated what? Our expected return. So now what do we need to do? Standard deviation. Remember, standard deviation exactly the same. So what do? X minus X bar, the whole square, right? Now, generally what do? We total it and then divide it by 6 we do. Here we should not do that. Instead, those figures multiplied the respective probability, automatically the final total will be what? It will be your variance. Are you all able to understand? That you square root, you will arrive at your standard deviation. Simple or not? That's all it is. So here everything is same. Instead of taking simple average, here you take weighted average. But for that, everything else is the same. Is this clear for everyone? Is this clear for everyone? Shall we do it now? So write down, take the heading. Calculation of, this part 2. Please write down part 2. Calculation of standard deviation of returns. Calculation of standard deviation of returns. Shall we get started? Guys? So now, what do we do first? So first, write down here. What did we use? Write down returns within bracket. We call this as X here. These are different possibilities. Is that clear? Right? What are the different possibilities, guys? Okay, first let us fill the top column. Right? We have X, guys. Correct? We have X. Then what do we do? Yes. So we do X minus X bar. Am I right? And then what do we do here? X minus X bar, the whole square. Am I right, guys? And after this, what do? We take probability and then we actually multiply the two. We will see X minus X bar, the whole square into probability. Is this clear? Shall we do it now? What are the 6 different outcomes that you can get? So these are the figures. Am I right, guys? So write down here. What is it? Negative? Yes. Okay, guys. So now let's do this. Now, first one, guys, returns. Come on, tell me what are the 6 possible returns? What are 6 possible returns? Come on, tell me. Minus 0.417. Huh? Hello. This we use for calculating this figure. What are the 4 different outcomes? This column, here you are multiplying with probability and you are arriving at the figure. These are the 6 possible return outcomes. Is that clear? Don't make a mistake. Right? That's why I asked you. Right? So here, what are the figures? This column needs to be copy pasted. Come on, tell me what and what. Negative 4.17%, then 0, then 4.17, very good. 8.33%, then 12.50%, and then 16.67%. Is that clear? Now immediately come down once again. It's okay, right? What is X bar? We already calculated, need not calculate it again. What is the figure? 7.083%. So write down 7.083%. Is that clear? So guys, remember, whenever we are saying X bar here, it's going to be 7.083%. Am I right, guys? So come on, tell me. So what are the figures here? 4.17 minus 4.17 minus 7.083. How much is that? Yes, how much is it? Come on, quickly. Minus 11.253. Then next figure. Minus 7.083. How many of you use calculator for this? 0 minus 7.083 is minus 7.083 only. Okay, so yes, next one. Minus 2.913, then 1.247. Guys, be quick with the calculations. Next, 5.417, 9.587. Am I right? Yes. Now guys, don't try calculating this. When we are using probabilities, it might not be exactly equal to 0. Right, because here it is not at the center of the population, so do not worry about it. But always, it doesn't make sense to use x minus x bar. We always square it. Do not worry, the logic is the same. Are you all able to understand? Right, here if you total and see, it might not be exactly able it might not be equal to 0 always. It's okay, don't worry about that. Is that clear? Now come on, x minus x bar the whole square, how much is that? 11.253 into is equal to figure, come on, quick. 126.63, then 50.17, then on 8.49, very good. Then 1.56, round it off. Yeah, then guys, give me the answers, come on. 29.34. What happened, ma? Are you guys facing any issue? Speed, slowly start getting the speed. Yes. What is it? 91.91. Very good, very good. Next, what are the probabilities? Come on, put it up here. Yes, 0.1, 0.1, 0.2, 0.3, 0.2, and 0.1. Even online folks, tell and write. In life, you will get only if you give. First, give it first, and then you can expect it back. Now, come on, multiply these figures. This into this. Move one decimal, that's all. No need calculator for this. 12.663, yeah, 66 we'll put. Then here also it's 5.017. Okay, then 8.49 into 0.2. How much, ma? 1.698. Then 1.56 into 0.3. You guys are understanding, right? Yes. 0.468, 7. I think it's 7. That's what is 1.56 into 0. Okay, 468. No problem. Come on, next. 29.34 into 0.2. Guys, give me the figures. 5.868 roughly. 91.91 into 0.1. Just move one decimal here. It becomes 9.191. Total it. This itself is your variance, not your standard deviation. So you need not average again. You just need to square root. Total it up. How much you get? 34.90. That's all. We took 3 decimals. No, 90. 905. 905. 902 is printed in the book. So do your calculation, please. Okay, 905 only. 902 varda. It's coming 2 only. Coming to 2. Okay, now this is what is this, guys? What is this? This is variance. Should you average once again? No. Why? By default, we have taken divided by sigma probability. Sigma probability is equal to 1. So it is already averaged out. That is the difference between your simple average and probability method. Is this clear? Many students commit this mistake. Once again, they take the average. No, you should not take it. Are you all able to understand this? So what should you do here? The total itself is your variance. Now you just need to do one thing. What is that? Square root. Averaging is already done. Is that clear? Now tell me, how much is this one? 34.902. Square root button. How much you get? 5.90779, 908% roughly. Is this clear, guys? And how to interpret standard deviation, I told you also. Is this clear for everyone? So now we have literally seen brick by brick, we have built it. From starting scratch, we started what do you mean by portfolio. From that, we built on to this particular level. We have seen how to calculate return for every year, and year-wise data. If you have a set of data, you can calculate all the standard deviation. No? First of all, only then you can calculate your expected return also. Are you guys able to understand? Standard deviation cannot be done without having a set of data. Is that clear? And the set of data can be either a past data or future data. You can't say, sir, 3-year past data, 2-year future data, can I take? You can't mix the two. You can't mix the two. If you are dealing with past data, take only past data, do simple average. Futuristic data, take a probability weighted average. Is that clear? And we have also seen completely how to calculate return, how to calculate risk for a single security, right? For a single security using both the simple average as well as weighted average. This is what we have seen till now. Is this clear, guys? Now, guys, go to the last page of your notebook. I asked you guys to bring 400 pages long size ruled notebook. Okay, even if it is less than 400 pages, which means you will have multiple books. That's about it. Now go to the lastest page. Okay, last page, right? Now, please take the heading, last page. You need not leave some pages gap and all. Come from reverse, it's okay. Call it as library of adjustments. For those who have already attended my CA Inter lectures, you guys must already be used to this. But for those who are new to me, let me tell you what this is. Guys, this is the wealth that you accumulate over the span of watching our lectures. You know, what is this library of adjustment? Now here, you need to have the following columns. Wait, I will first draw it. Only right now, only once I will tell you. At the end of every sum, we will be coming on and we will be updating this scoreboard. Is this clear? This is like a scoreboard, right? Now, I will first write down and then you can write it. Okay. Now, first you can have chapter number, small column, then question number, once again a reasonably small column, page number, small column, adjustment, biggest column. What is it? Right now, what was the chapter number that we did as per our order? As per our order, chapter number 2, right? Basic concepts. Now this is 2 is what? Your portfolio management. 2. What was the question number we did right now? Now what one? This is test your knowledge, TYK1, because illustrations will be 1, 2, 3, 4, 5, 6, 7, 8. Once again, TYK will be starting from 1 and MRP will be starting from 1, 2, 3, 4. Sir, why have you done like this? Because suppose suddenly I say add some new sum. Now what we'll have to do, we will insert it in the end in that numerical order. If it is an extra illustration sum, we will put it here. If it is an extra TYK sum, we will put it here. So students will be having a complete view of all the sums in a single place, right? And if suppose an ICI study material sum is there, but that was also asked in exam, once again in MRP category we didn't repeat. Here itself we have added the source. So we have avoided repetition. Now under single sum, if you have multiple sources, clearly you know that institute gives a heavy weightage. This is actually the lot of work that has gone behind it. Guys are clear with this. So now what you need to do is, you can just write TYK question number 1. Okay. Now this is question number. Now under the page number, what you should write. Now this question is printed on which page number, guys? Page number 8, 9. Page number 9 of the textbook, and also write in your classwork in what page number you have written the solution. Right? That's why I asked you to number the notebook. I don't know how many students will actually follow this. Of course, face to face, you guys will follow it. I know for sure. Online folks, please do this, because this is the tracker of the sums that we actually solve. And day by day, sum by sum, I will be dictating this library of adjustment. You can write it down. This alone I will dictate going forward. These 3 you guys can update. You guys can update, no? This also you want me to dictate, huh? You should only write it. Okay. I will dictate this, guys. And you will not believe this. I have received a phone call from students at 5:02 p.m. after coming out of the exam hall. Sir, without your library of adjustment, we could not have revised the subject in 1.5 days. Guys, you are preparing for that 1.5 days. If you have to revise the entire subject the day before your exam, you should have a kind of control which you have never had before. You you tell me, no, how many sums are printed in our question bank? I just showed it to you initially in the in the initial class. I showed you ICI study material question 321, MRP, MTP, RTP, and past exam questions is 210. A total of how many practical questions? 531 questions. How will you have a control? How will you have a control? This is the control tracker for you in your own handwritten notes. Is this clear, guys? Now, sir, is one page enough? Absolutely not. So you can go from reverse. So you finish this last page and go back. You can do it from the reverse. That's how we can't actually time it or predict it. Is that clear? Because depending on your handwriting, the number of pages you require in the front will be more or less. I do not know. So come from the back. Who's stopping you? Is this clear, guys? Guys, this is actually the true wealth that you accumulate over the course of our lectures. Is this clear? Is this clear? Now please go and update your library of adjustment. Write down. Single security, risk and return hyphen probability. Is this clear? Are we done with this? Single security, risk and return hyphen probability. That's about it. Now if you read this one line, you know what is the crux of the sum. In this sum there was not much of any adjustment. If you have some adjustments, now those things I will ask you to write in a red ink the day before exam. Let us say you want to revise all sums relating to single security, return, that too with probability. One look, you know which sums to actually revise. If suppose you feel I'm not that confident in standard deviation, let me just go all the sums involving standard deviation. Here it is single security. We will be seeing portfolio. Portfolio means what? More than one security is a portfolio. Portfolio risk, portfolio standard deviation. Now all the sums governing that, if you want to revise, how will you do that? Unless and until you have this tracker. You guys are getting this. This I'm telling you guys, please follow it sincerely, because you have no clue. I'm not going to benefit out of it. You are the one who is going to benefit. And guys, this was something that I followed during my exams. I followed during my journey as a CA student. When I was a CA student, I followed this. And this library of adjustment is not the name which I gave. This was given by my faculty, my FR, Financial Reporting faculty, MP Vijay Kumar sir. He's currently in Central Council he's a Central Council member, and he's a legend. People literally worship him. He's a legend. He's from, I think, Visakhapatnam or Vijayawada. A legend in the subject, FR, Financial Reporting. Even this color coding that I told you, I followed all that because he told us, and I am just passing on the legacy. It is not my creation. It has benefited me, and I'm passing it on to you. That's about it, right? If you follow, it's extremely good for you. Guys, the day before exam, I saw the magic. In my class, during our classrooms discussion, lectures, I used to take a lot of running notes. My blue ink will be extremely more than the black ink formal notes, right? My handwritten notes will be much more. Even if he just says some random example just like that, I will write that also, right? In my own language. It will not be fully, but of course you can't get into that speed, but in my own understanding, if I look at it, I know what he said. You can relive the classroom moment. And trust me guys, 1 month before exam, I was in heavy demand. Everyone who wouldn't take notes, they used to ask me, hey, what is this concept, sir? Explain one example. Can you just tell me? Guys, that is the power of note taking, and that is also the power of conceptual learning. Now, he's a true legend. Fortunately, day before yesterday, I happened to meet him, and in fact, I also met our present president of ICAI. So fortunate where I could meet about 15 past presidents of ICAI in a single room. We had another past president had invited me personally. So they have completed 50 years of practice in their firm. So I was fortunate enough to be invited as a guest, and I had the absolute privilege of actually meeting him once again. And I told him this, sir, in my class I quote your name and I tell them that I'm just passing on your legacy, because he quit teaching 10 years back, because there is a rule, if you're getting into the Central Council, especially in the examination committee, you can't teach. He taught for about 25-30 plus years. He's a CFO of SIFI Technologies, for those who do not know. So it's a big company, and he's been a CFO for the last so many years. A great legend. And the best part about his lectures is He teaches financial reporting without using the board. Orally, he makes you visualize a subject. I mean, I'm not sure how how many of you can connect to this, because it's hard to believe unless and until you actually experience. Right? He doesn't use the board. Nothing, no visuals. He orally teaches, makes you visualize. That is the kind of command and control he has over the subject. We were fortunate enough to learn under him, and I'm just passing on the legacy. And this library of adjustment, guys, is a true treasure for you. Is that clear? Right? Please do follow this. Right now, before we wind up for this particular session, quickly, can we just summarize and have a look at our concept decoder book? Everything has been mentioned here. Quickly, I will just go through it once, and then we will wind up for this particular session. Shall we get started? Right now, guys, now let us read. You will understand every word. See, this this book here is there. No, this is a very good tool that supplements our classroom discussion. It can never replace our classroom discussion, because I told you in the first class, I consider myself as a faculty, a teacher, not an author. So the knowledge transfer happens only through the lectures, not through my books. But books are very much useful to actually assist this particular learning experience. Is that clear? Let's quickly get started, guys. Not beyond 5 minutes, we'll quickly get going. And you guys are going to participate, will you? Ekla, Satama. Yes. Right. So the chapter introduction: in our everyday life, we often encounter people who own various assets like stocks, bonds, gold, etc. In most of the cases, these are bought at different times without a clear plan. Though investment in these securities may be rewarding, it also comes with risk. Therefore, investment in these securities requires good amount of scientific and analytical skills. Portfolio management is simply the process of bringing all these scattered investments together and managing them as one single basket. You will understand more about it as we enter into the next segment called portfolio. Portfolio risk, portfolio return, right? Next, this single basket is called portfolio. I told you, no? So a collection of something is called as a portfolio. Next, as per the famous principle of not putting all eggs in the same basket, have you heard of this? Have you heard of the saying, do not put all your eggs in the same basket? Have you heard of this? I'll tell you what it means for those who do not know. You buy egg, right? If whoever buys egg, right? Now, if you're putting every egg in a same basket, the chances are one slip, all the eggs will drop and fall, and all the eggs will be spoiled. Instead, if you place each and every egg in a different place, even if one packet falls, at least that one loss is only there for you. The others will still be actually providing for you. Are you guys able to understand? This is called, this is basically something which people say, do not put all the eggs in the same basket. Basically, they say, do not put all your money in a single stock, a single avenue. Diversify, put it in multiple avenues so that your risk is actually reduced without diluting your returns. Is that clear, guys? Are you getting the analogy? This is what they are saying, right? And yes, an investor should never invest his entire investable funds in one security. He should invest in a well-diversified portfolio of number of securities to optimize the overall risk-return portfolio profile. This is the example I gave you. 10 lakhs you have. Instead of putting everything in a single stock, and you can actually do it in multiple. Investment in a portfolio can reduce the risk without diluting the returns, and an investor who is an expert in portfolio analysis may be able to generate a lot of trading profits on a sustained basis. And I walked you through this chapter overview. Right now, where are we, guys? We are in this particular segment, risk and return, and under this segment we have now completed single security return, and we have also completed what? Single security risk. Right now, quickly let's give a walkthrough here. Now, risk and return, I've just mentioned a few things here. You can go through it quickly later on. Main thing I will just actually read. Now, single security return. Now, what is the formula we saw? Guys, come on, everyone. So P1 minus P0 plus D divided by P0. Suppose if you are calculating for year 3, it means P3 minus P2 divided by P2, the base, right? And of course, plus D will be there in the denominator, in the numerator. Is that clear? Basically, simple. The upcoming price minus the old price plus dividend divided by the old price. That is the base. So year on year, the opening value will be the base, and you will calculate it incrementally. Is this clear for everyone? This is what we have seen, right? And suppose this is for what? Calculating each year return. Now, if you have year-wise multiple year data, right? Now, how do you calculate the expected return? Either using simple average or using probability-based weighted average. Simple average, how will you do? Sum of all the year returns divided by the number of years. So this is the formula, sigma x1 plus x2 plus x3 plus whatever divided by the total number of years. Is this clear? This is what we've seen. And similarly here, suppose if you're using probability, I told you sigma p into x ideally divided by sigma p. That's why sigma p is equal to 1. The denominator is not required. Are you guys now able to understand? This is what I told you. Guys, clear? And I also told you the concept of holding period return and how to annualize an holding period return. Compound interest, I told you, we will anyways be seeing in time value of money chapters, right? This we will be seeing it later. And as you guys know, whenever dividend they have given, okay, when they are saying dividend is 10%, so how will you calculate the dividend amount? Is applied on the face value. You guys are aware of that? Yes, perfect. Now single security risk. Before that, guys, one thing I want to tell you. Now here this formula is there, no? P1 minus P0 plus D divided by P0. Guys, can I rewrite this formula? I'm writing it here. Can I rewrite this formula? Just a simple thought process. P1 minus P0 plus D divided by P0. This is the formula to calculate what return? Correct? Can I rewrite this formula as P1 minus P0 divided by P0 plus D divided by P0? Simple. I'm just splitting and writing. So I'm saying this plus this. Correct? No, denominator is the same only. Instead of putting it in a single numerator, I'm splitting it. Guys, correct? Correct? Or in other words, can I say this is nothing but my capital appreciation as a percentage? This is nothing but my dividend yield as a percentage, not my dividend rate. That is calculated on face value. I'm saying return, dividend yield, dividend divided by what? The amount I invested. Guys, correct? Now suppose in a question they have given the capital appreciation percentage and dividend yield percentage, you need not do anything, just add the two. That itself is going to be your return. Are you guys able to understand? Now guys, please remember, this dividend yield is different from your rate of dividend. Dividend rate is what? The dividend declared by the company, that is multiplied with the face value to arrive at the dividend amount. Here we already have the dividend amount. That divided by the amount invested gives you the return that you are getting exclusively from dividend. Are you guys able to understand? So that's why we call it as yield. Are you all able to get this? So capital appreciation yield plus dividend yield is basically your what? Your entire return. Guys, are you all agreeing with me on this? So if a data is twisted like this, then you will be able to handle it. Guys, getting it? Now this is how, these are the things which actually ICAI did in this May 26 exam, right? So they were giving a lot of data which was not directly available. This is a very basic thing, but on a higher level I'm saying. So if you have a complete control and command over the subject, any kind of question you will be able to answer or not. You tell me, guys. That's about it. That's the power of conceptual learning. Is this clear? Right? And quickly let's move on to the next one. We also saw how to calculate what? Portfolio risk. I'm sorry, a single security risk. So single security risk we saw in case of simple average. So the total column, that is sigma x minus x bar the whole square divided by n. Guys, that's what we did. And in case of weighted average, what will you do? Sigma probability into x minus x bar the whole square, ideally divided by sigma probability, but this is equal to 1, hence it's not required. Are you all able to understand? Any problem, any issues? Guys, clear? This doubt busters, I'll come to it later as we do a numerical problem. Is this clear, guys? Right? And that is exactly what we have covered till now. Till now, guys, you tell me, are you all having a complete control over this particular area? Yes, this forms the base for the remaining part of the chapter. So slowly we will be adding complications to this. Fine? Great, guys. So on that note, I am signing off in this session. So please revise till whatever we have covered till now. I will see you all in the next one. Thank you all so much.